Okay. I am Paul Stamoulis, a senior consultant at One Stop Capital, a strategic financial consultancy. Welcome to this edition of the Funding Strategies Conference, where we will speak about smart loan options for the financial marketplace. I want to welcome our panelists and guests joining us today, as well as to give a heartfelt thank you to our sponsors, which are the Funding University, ThermoCredit, Channel Vision Magazine, and Remote Work Solutions, or RWS. And let's get started by introducing our panelists. Our first panelist, Mr. Seth Block, CPA, who is serving as both a sponsor and a panelist today. And Seth is a founder and a board member of ThermoCredit. He's been working with the management and development of a service-based companies for more than 30 years. His diverse experience in lending includes consulting for startups, mergers and acquisitions, and delivering funding solutions for hard-to-finance companies. Our second panelist, Brett Atkins, is also joining us today. Hello, Brett. Brett serves as Vice President, SBA Lender, and Relationship Manager at Home Trust Bank. He holds 18 years of experience in both business and consumer banking and is a recognized expert in SBA lending. Mr. Spencer Sheinin is our third panelist, founder and CEO of Shift Financial Insights. And Spencer has a unique combination of skills in both accounting and entrepreneurship. He's a 20-year CPA and a best-selling author, and he's owned businesses in manufacturing, construction, cold storage, real estate, and now financial services. Last but not least, let me introduce Mr. Dan Noble, a partner with Florida CFO Group, and Don holds a doctorate in business administration. He's an expert in technology at high growth and startup companies, and his familiarity with M&A is vital to our discussion of the entire M&A process, including strategy, deal types, due diligence needed, hostile takeovers, valuation, and integration. Thank you, everyone, and let's get started, shall we? Our first question for smart loan options for small businesses. Question number one, what are the essentials about lending and lenders that every small business owner should know? What are the essentials? Don, would you like to take that on?
Well, thank you, Paul, for the introduction and for the first question. I appreciate it. I would say that for most small businesses, they fall into two groups of things they need to know. First of all, they're the group that have enough assets and have enough cash flow to quickly get loans. And then there's a second group that, let's say, may not have that much, and they need to go to an SBA route or some other route, perhaps a different type of lender to get that loan passed through. Both of those, though, end up the same way. Know your lender. When you're going out to market for some type of loan or some type of asset loan or some type of equity, doesn't matter. Know the person that you're going to, because they're going to help you determine what type of loan facility or what type of equity facility is appropriate for you.
Well, thank you very much. Seth, would you like to add anything to that?
I would. I would add that whenever a small business is dealing with a lender, that lender is going to do due diligence on them. It's imperative that the borrower do due diligence on the lender as well. And what I mean by that is he should talk to other folks that have done business with that bank or alternative lender and really understand how their program works. He should ask for sample documents to see how the covenants would work. Really understand what he's getting into before he goes too far down the line.
Well, great answers. Thank you very much for that. So our next question is, who offers the best small business loans right now? Is it banks? Is it alternative lenders? And why is that? Who wants to take that on? Spencer?
Sure. I think that's such an interesting question. And probably the biggest lesson I learned when I was an entrepreneur, and I also see this with a lot of our clients, is it's actually unique to the institution itself. Each institution is going to have whatever they're into right now. Maybe they're overweight in manufacturing. Maybe they're underweight in small business. And so actually, I think the effort is less about, do I go to a bank or a credit union or a third-party lender or something like that? I actually think it's really important to go out to a bunch of them, sample them. If you're in a position where the loan is critical to your future, like 10 different types of institutions or 10 different packages out to different types of institutions, somewhere in there, somebody's going to be like, we need more of this type of client. So less to me about what type and more about finding the right institution for what you need in that moment.
Makes sense. Seth, anything to add?
Yeah, the only thing I would add to that was a great answer by Spencer, but the only thing I would add to that is that the lender should really look at, what he's borrowing the money for and what's more important to him. Is it rate? Is it availability? Is a lot of times is he going to be able to get a certain type of loan? So he really should kind of research that as he goes out into the marketplace.
Mm-hmm. Okay. All right. Great. Okay. Next, let's see. How can banks and alternative lenders work together? Let's see. Seth?
Sure. So we do work with banks. To me, the most important thing is to understand the process very early on, to talk to the bank and the alternative lender, vice versa, see if they're even open to the concept of working together, of signing an intercreditor agreement. Sometimes it's a subordination agreement. But the best advice I could give on that is understand your long-term goals, understand if you're going to need two different types of lenders so that you can get those lenders working together early on. It's very hard to come in with a second lender when you've already had a facility in place for a while. That initial lender is probably not going to be real open to bringing somebody else into the equation unless you've been talking about it all along.
And Don, maybe you can answer, how do you find these best business loans?
Well, I would say two ways. First of all, you should have at least some advisor on your team that knows the different players. For example, I know Seth, Brett, and Spencer now. If I need something in particular, I can go to them and ask a question. I would say the second, I'm going to come back to what Seth said in the original question. If you've got a good banker, if you've got a good alternative lender, they will bring in the opposite party if they feel it's necessary. That's very important. So you got to, I gauge a bank. I've gone to a couple of banks that I know, and I'll say, hey, listen, I have such and such client. A good bank will say, hey, listen, I think we should bring in an alternative lender for part of this. So that's a good way to know a good bank or a good alternative lender as well.
So you're saying ask the banker to complement their own ability with another alternative lender or not?
Absolutely, because let's be clear. If you're a lender, you know every other lender in whether it's another bank. So absolutely, why not use their network as well to get you the right solution for your business?
Uh-huh. Now, Spencer, you want to add anything to that?
I just want to second what Don said, and whether it's your banker, your lawyer, your accountant, all of the professionals that you already deal with, they'll have other clients similar to you, and they're going to know who's likely a good fit. And even further to what the answer I mentioned before about finding the right bank or credit union, there's all these alternative lenders that many of us have never even heard of that are specific to unique industries, whether it's equipment loan financing for construction or whatever it is. And they're very, very niche players. And using your network to find those niche players is a good way to get a step up than using the Google machine.
Okay. Well, thank you for that, Spencer. Our next question is, how can a business owner protect themselves from predatory lenders? Who wants to take that on? Don?
Wow. I'm not sure how to protect against predatory lenders if they're actually going to come after you, but I would say my first step is looking for the background. Going back to Spencer's comment, doing more of a background check on a particular lender. And my rule of thumb is if it's too good to be true, then it's too good to be true. So somebody comes to you. In fact, I'll tell you a story if you can hear. We had a lender from South Africa give us a call, wanted to give us a loan at half the market rate. And that was a pretty much key indicator that they were a predator and trying to do something. So that's if it's too good to be true, don't believe it.
Okay. All right. That's good. Good answer. So too good to be true. So our next question is, what are good and bad reasons for a small business owner to borrow money? Seth, maybe you can start us off with that one. What are some of the good and bad reasons for business owners to borrow money?
Well, I would say in my opinion, the best reason is opportunity. They've got an opportunity in front of them, whether it's an opportunity to grow their business organically or it's an acquisition opportunity. I know as a lender, those are the instances where I really like to work with companies. But there are other good reasons. If they're having working capital issues and they can solve it by leveraging the company properly and running the company more efficiently, that's a really good reason. The other reason may be is that they've been hit by a surprise, a tax issue or something like that, and they need some leverage to correct that so that it doesn't damage the business. The wrong reasons to borrow money is probably borrowing money when you truly don't need it, or you think it's just a great deal. I'm just going to go ahead and borrow the money. I see that a lot with merchant cash advance loans, where they'll reach out to customers and say, hey, look, we can get you $100,000 here. The company really didn't need it, but they take it on and it ends up damaging the business. So, from that standpoint, they shouldn't take on leverage when it doesn't make sense for the business.
So, Spencer, you want to add anything to that?
Sure. And I mean, I think I'll just go to the bad reason, and it's when the business is systemically broken. We all get so committed to our businesses and we're so sure we're going to do it. But if that business is systemically not producing funds, or we haven't gotten product market fit, or it's not working, throwing more money on it's just going to make it more painful. And Seth started with a good reason is for opportunity. A terrible reason is to cover over poor performance. Sorry.
Don, any other good or bad reasons to borrow money?
Let's start with an easy one that came off of what Seth said. A bad reason to borrow money. You need a little bit and somebody brings you a lot, or you need a lot and somebody brings you a little. If there's a mismatch, first of all, don't do it. A good reason to borrow money, you have a solid plan in place and you want to grow. You want to leverage some assets of the company to accelerate your growth going forward. The bad reason out of that one is as well, if you don't have a good plan and you think just grabbing some cash in your bank is going to help you, don't do it. So there's just a couple of examples, and again, off of both what Spencer and Seth said.
Okay, excellent. And well, that's a good lead into the next question. And what are the best types of loans to prepare for business's future needs? Don?
Well, asset lending, if you have a lot of assets, is a good way. If you have a building or something, that's a very solid asset. That will continue to appreciate just like your house does. And that's a good way to accelerate your growth. I would say the second probably most popular is just something off of something that can just give you some working capital in the business. So a working capital loan, whether it's a permanent or temporary working capital loan would be ideal. Again, I've gotten some SBA loans for companies, let's say $3 to $5 million, and have really accelerated their future growth. So there's something like that.
Good stuff. So, is there a time when over borrowing is actually a smart choice for a company? Who wants to take that on? Anybody?
Yeah, I mean, I think I agree with what everybody said up till now about don't just take money because you can. The time that I think it's helpful, particularly for smaller business that might have some cyclicality in it or some good years and bad years, is getting access to capital when things are good. Because often getting access to capital when you need it is impossible. It's, we've all heard that, and it's super true. So after a couple of good years, it might be like, I don't need it, but now's when I'm going to set up my facility. There may be some costs associated. There may be some carrying costs associated with it. But just getting it in place when the underlying foundation is solid is a lot easier than when you come in kind of like wobbling on one leg, hoping nobody notices.
Well, yeah, and I would think with the interest rates going up the way they've been, borrowing a couple months ago or a year ago would not have been a bad idea, right? Compared to now.
Yeah, you're just reminding me that I'm about to renew my mortgage. Thanks, Paul. That's helpful.
Well, there's that old adage, Spencer, that's don't borrow money when you need it, borrow when you don't, right? So,
hey, let me just put a little cap on that as well. And as I said, there might be a little bit of cost on this, but if you do borrow money because you can, let's just keep that in a really secure location and don't just let it float in the business, because it's really easy for cash to get consumed in an operating business just because it's there. There's something about having that tightness and having to run against a line for, the senior leadership team to know they don't have a big cushion to spend when it's really that sort of like that over borrowing, now's a good time capital.
if I can go a little bit further, Paul, I think Spencer and I are going back and forth, but take an example from a large business. When they have excess cash, they do an ROI and they rate ROI. So if you got some excess cash in the business, Spencer's right. Don't just throw it around. Make a list of all the potential projects you got that can help you out and see if you can put some of those items in there. I mean, even a small business can take the benefit of that.
Right. So in other words, be prepared. Yeah. Well, it makes sense. And how about a safe level of debt for a small business? What would you consider is a safe level of debt? Spencer or Don, either?
Yeah, I mean, there's obviously the technical analysis that goes into that, which I think Seth or Brett would probably be better to speak to than me. I think a safe level of debt is that one that you as an owner can sleep at night, and I know that's not technical, but debt can be really crushing for a lot of people, and some people are comfortable with debt. If debt is crushing and you can't sleep, that's not going to help. So a non-technical answer, having been an entrepreneur and felt the weight of debt, I have my own sense of as I leverage business and what I'm comfortable with, regardless of what the fundamentals are telling me.
Well, that makes a lot of sense. Definitely. Don, you want to add anything to that, or?
Well, actually, I love that common sense answer. I could have given you some ratios that Seth and Brett could confirm, but no, I actually kind of like that. If you wake up in the middle of the night with night sweats over making your next loan payment, you've got too much debt, pretty much.
Yeah, that's a good rule of thumb there. Okay, and how about a mix? If I'm an entrepreneur looking for that perfect mix between debt and equity, is there a recommended mix of debt and equity that we could kind of balance together? I want to take that on.
Why don't we throw that to Seth from more of a technical or fundamentals perspective than a feel?
Yeah, so I can tell you, we like to see that number, and as an asset-based lender, we're probably not as focused in on it as much as maybe Brett is or some other lenders. But we like to see, 1.5 to 1. And what I mean by that is we like to see equity be 150% of their debt. We're going to look at that. We're going to look at that as kind of a rule of thumb. Now, will we do it if that number is not quite there? Sure. But we do track that. We don't like to see a company have more debt than equity, for sure.
Mm-hmm. Or 50% of their equity value max.
Yeah, we like to see at least their loan be, their equity be 150% of their loan balance. Yeah.
Okay. And how does a business owner, Seth, I guess this is probably a good question for you. How does a business owner find industry-specific funding? It's funny. I mean, being an industry-specific lender, I can certainly speak to that. And it's almost the same place I find customers. So it's talking to people in the industry, talking to other companies in that space. For them, they want to talk to, even if it's a competitor, where did you find your funding?
certain industries, it's very hard to find lenders in those industries. So everybody over a period of time knows who those lenders are. Another great place is trade shows. If you're, like for instance, for me in telecom, if I'm at a telecommunications trade show, it's a great place for people to find me because I'm there exhibiting because that's my target market. And if a lender is a specific industry lender, he's going to be at those trade shows, probably exhibiting and promoting his product there. So I would say those are the two basic. The others obviously is the internet. I mean, you can Google telecommunications lenders and ThermoCredit will come up. So those are all good places to find specific industry lenders.
Seth, you brought up a point there that's interesting. You can Google somebody, but they may put telecommunications on their expertise, and they're not even close. And I think small business owners need to be aware because you get somebody that doesn't know your industry, you have to educate them, and you might have to educate them what's on the balance sheet and what's on the income statement that an industry expert would know inside and out. But an uninformed lender doesn't know what you're talking about. So got to be careful there as well.
Yeah, no, that's an excellent point, Don. And to that point, I would say again that once you have found a lender that you're interested in, you should talk to other people, find other people that have done business with them to see if they truly do know the industry or not.
I'll just piggyback one quick thing, if you don't mind, just to point out, Seth and I met at a trade show for exactly the reason he mentioned. And, I imagine Don and we exhibit at industry specific trade shows where we have expertise. So whether it's, and some of those are coaching organizations that are designed for specific trades within the industry, HVAC, they've got all the HVAC equipment vendors there, but there's all the financing companies that finance HVAC businesses. So whether it's the trade show or a coaching organization or even an industry association, they'll almost certainly be sponsors for finance and lending sponsors to most industry associations.
Okay, great. So let's see, what's the next? And how about advantages and disadvantages of debt financing? We talked about the levels of financing, of debt financing, but now how about the advantages and disadvantages of debt financing? Don?
Well, advantages are relatively easy, and I go back to buying your house with a mortgage. The house value goes up, the mortgage doesn't. So you get equity, and you get some positive benefits out of a nice, stable lending relationship. On the disadvantages, you can overborrow if your sales go down and you don't plan for it. Your debt to coverage, or your coverage ratio is not as strong as you think it would be, meaning you can't pay off the loan, and you can't pay off if it's a balloon payment or a note of some type. That's a big disadvantage because, again, as Spencer said, you'll wake up in the middle of the night, sweating the fact that you got to do it. So I'd say that's one advantage and one disadvantage right there.
And is it harder right now for a small business to qualify for debt financing based on the economy that we're in?
Well, I think I'll start that, and I'll give it back to Seth. That's okay. What we're seeing is it's not any harder for the same business to get debt financing if they have the same financials. So, but the problem is that with the recession possibly looming, sales have gone down a little bit, asset values have gone down, but expenses have gone up. When you change those variables, it makes it a little bit more difficult for them, the same type of company, to get the lending that they need. Seth, would you agree with that? And based on the companies that have come to you?
Yeah, I would absolutely agree with that, Don. And I would add one thing to it. And I see it in my industry, and I also see it from just conventional lenders, is a lot of these companies, a lot of these banks have a debt service ratio in their agreements, and the EBITDA, or the net income for that company, is going to stay fairly constant, but the cost of debt is going up because interest rates are going up, and therefore they may not qualify for a loan anymore because they can't meet the debt service ratio. And we are starting to see some of that. in our industry, as well as, like I said, in talking with conventional lenders, they're running into it as well.
Uh, Spencer, you want to add anything to either? I mean, the two questions we had, what are the advantages and disadvantages, as well as is it harder now to qualify for debt financing?
Yeah, maybe I'll hit the second question, and it's not so much is it harder, but I reflect on Seth and I have had this conversation a few times where, those that are looking for financing, putting together a really good finance package, as silly as and intuitive as that sounds, and Seth will be able to answer this better than me, but like how many really, really good packages come in with all of the information and thinking through everything Seth is going to need to assess if they're going to give you the loan. And I don't know, you can tell me out of 10, how many are really complete for you, Seth, would you say?
Oh, it's not even 1 out of 10.
Yeah. So, and then the next step to that is when there's follow-up questions, be it Seth or whoever you're borrowing from, comes back and it takes 3 weeks to get a relatively simple answer back on something to do, say, with gross margin. All of those things are what's making it difficult. Regardless of what the environment is, there's always capital to be had. Always, always, always. And putting yourself at the top, and Seth, you said it goes to the top of my stack for sure. And it's a combination of a complete package with a really good story to go with it. Why are things going well? Why did we miss our numbers? We had a little dip here. This is why. This is what we're doing about it. So that as the reader, if I'm a lender looking at this going, wow, they got it together. When I go out to a restaurant, I go to the bathroom and it's a disaster. You think, what's going on in the kitchen, right? If you can't even keep the bathroom clean. That's kind of like the financials. The financials are the bathroom of your business. If that's not clean, the rest of your business is probably a disaster too. So,
and that kind of begs a question of why are these entrepreneurs not as well prepared? I mean, these are smart individuals. They're running a business. They know they need to borrow money. You would think that they would line up all their ducks, fill out all the due diligence. Why? What is it? Is it that they're in a hurry? Is it that they're? What's the answer to that?
I mean, I'm happy to take that real quick. Like, I think there's a few absolute central issues there. Number one is accounting is a technical language. Don and I both went to school for years to learning how to write, create, and interpret financial information. Most entrepreneurs didn't. They came up with some sort of technical track, whatever their industry is. So, it's actually, we're speaking a different language. And then what happens is, as accountants, and I think Don would probably agree, this happens a lot, is we hand financials over to the entrepreneur, expecting them to diagnose what's going on in their business. But that's actually an unfair ask. It's like me trying to read an MRI. Like, good luck. It's just a bunch of squiggles on a page. And then kind of the third one, and this is particularly the smaller the business, the bigger the problem, is the old accounting stack problem, which is, you build a house, you've got a general contractor, sub-trades, and laborers. They're all part of building the house, and you would never hire a laborer to build you the entire house. Whereas in a finance department, you've got your CFOs, your controllers, your bookkeepers. You would never, but we often just hire a bookkeeper to run the entire department. So we're expecting the bookkeeper to build your house, but they don't have all the skills. We need somebody in the CFO level with Don and his group. We need a controller and we need a bookkeeper. And so we when I have my entrepreneurial hat on, luckily I was a CPA, but a lot of the entrepreneurs don't speak the language and don't even know what to ask. And it's actually embarrassing. It's embarrassing as an owner to not know what to ask about your numbers.
Great answer. It's a great answer, Don.
I'm going to jump, Spencer. I want to add to that. There's another component that the CEO also doesn't know what the bank or lender wants. So I can't tell you how often I'll get into a room with the lender, with the CEO and myself, and they'll ask some question like, how many times do you turn over inventory? And the CEO doesn't even know why he's asking it or what the number is or what it means to his business, because every day he or she just built the business. That's what their job was. They didn't worry about, and I picked inventory, but they're more complex questions where how many times have you heard a CEO go, well, why are you asking me that, in a negative way? Like, You don't need to know that figure. You don't need to know why do you need to know how much personal expenses are in my income statement, right? For example. Yeah, Seth, right? I mean, how many times have you heard that? And they go, why do you need to know that? That's my business, not yours. And you need that professional to help guide that.
Good answer. Good answer. Seth, anything else you want to add to that, or?
No, but I would like to go back to the first question about the advantages of debt financing. And we touched on it a little bit, but to me, the number one advantage is that you're not giving up equity to get the capital. Okay. That's kind of my mantra.
Good point.
Keep as much equity in your company as you can.
Well, good point. And I think it's also a rule of thumb, right? If the entrepreneur is willing to give away a lot of his company, then you have to begs the question: how much confidence does he have in that company, right?
Right. I've said it a million times. If you're looking to raise capital and you think your business is worth, a lot on an exit, you should hold on to as much equity as possible. If you don't think it's worth anything, then, bring in as much equity as you can.
Okay. So tricks of the trade here. So how about the business situations that best suit short-term loans versus long-term loans? And I think we touched upon that earlier with the type of loans, but now this is what sort of business situation is better for short-term loans. Let's start with that. Brett? Brett's not with us. So Spencer.
Yeah, I mean, I've always thought, and I mean, it's relatively old adage, but if it's a long-term asset, it's a long-term type of financing. If it's a short-term asset, it's a short-term financing. And so situationally, I kind of bend around that. Like, are we in a growth mode? Is that a short-term strategy, which is going to be able to pay it back in a year or so? Or is this a long-term play that's going to take 5 years to really play out this growth strategy because it's new or a new industry? So the long and short term for the asset type, I think works similarly well for long and short versus business strategy and what you're going through in business at the moment.
Okay. Don, you want to add anything to that, or?
Well, I definitely do. I like to go through examples. A short term, when I come into a company and I look, let's say that a short term loan would best fit. Let's say a company's got good management, but they just got a large order in and they just need a gap between their inventory, their accounts payable and their accounts receivable for short term. Good financials, but they just need that bump. So you look at something that just helps them get over that hump. Then you go back and you say, that you get another company that just introduced a new product line and they need to put some salespeople on the ground. There's already some traction, but they need a 5-year, backup in their capital to solidify that opportunity. So there are two examples of how you would separate. And of course, a lot of things fall into those two different buckets as well.
Mm-hmm. Okay, great. And Seth, you want to add anything to that? Or?
Yeah, the only thing I would add to that is I see situations, and they're typically short term, where a company has taken on a new client. The client has come to them for a specific thing, and it's really going to impact their cash flow. A lot of times using PO financing or even factoring can be a really good solution to a short-term short-term capital need.
And I'm happy to put a bit of color on that with an example. I thank you, Don, for bringing those examples. In my old manufacturing business, we won a contract that was a product we all know, although it was always under confidentiality, so I can't share. But we were making, it was like a moisturizing pad because it was a skincare manufacturing. And it was a contract for between 3 and 4 million units a year. So our upfront cost, we had about $750K worth of new equipment and about it was over $500,000 worth of inventory just to prep for the first order. So that's like exactly what you were talking about, a new product, a new service, a new whatever for the business, new client. We had actually 2 different types of financing to help us through there, because one was that long-term equipment and the other was that shorter term inventory, which we needed. because it's a regulated industry. We had to get sign off before the POs could be issued. It was very painful. But that financing is what allowed us to get over the hump. And it was unique to each part of that new relationship.
And where were you going? What type of entity are you going for these different types of loan?
Yeah, so the shorter term, the inventory loan, that was more like we financed the POs directly. So we just factored those POs with a percentage for the pleasure, and the rest was a capital asset loan. I believe this was a few years ago. I think it was a 5-year amortizing, flat amortizing loan for the equipment.
Okay. All right, great. The next question is, when should a business consider hiring a loan or finance consultant? And as an add-on, what's the best way to find such a person? So, Don?
Well, I'll be selfish and say hire me. But in general, this goes back to the same question you asked before, Paul. Find the right person that's got the right knowledge. If I was looking for something in an industry that Seth was an expert in, I would call Seth, right? And I would say, Seth, listen, I don't know if we can go with your credit, but would you mind being an advisor to us, for example? If you're slightly larger, you're looking for a larger facility, 5 to 20 million, I would definitely pick up Spencer and say, Spencer, hey, listen, can you do my capital raise here? I want you to make sure the books are in line, send the stuff over, and so on. So when do you hire somebody? I would say that almost every time you get some type of advice, when you hire someone is whenever you want a very high success rate. If you go out to one bank that you've known for years and they turn you down, that's a very low success rate. When somebody hires me to go out and do something, especially a fundraise, I'll find 13 to 15 lenders, possible lenders, across the board. They could be different components, and I'll make sure that it fits what's going on. So going back to when is a good time, I would say almost every time you get somebody, when you pay someone, would be when you're the numbers that you're working for and the risk and the return is high.
And how about how do you go about finding one?
Well, again, this comes back kind of sort of. I'd almost go to your lender. I mean, Seth, I'm going to pick on you a little bit. Hey, Seth, listen, I've got this manufacturing business. I met you at the conference. I'd like to get an advisor to help me go through my books and so on. They're going to know people they trust and respect. And to be upfront with you, banks call me, and I'm sure Spencer can talk to this. Banks will call me, lenders will call me directly and say, I've got this client, they need help. Can you go in and do it? So they're going to know the right people to help you out. So my first stop, I'd call up a lender that I know and say, do you have an advisor that can help out?
Okay. Makes sense. Makes a lot of sense.
I think that's, let me just add something real quick, Paul. I think that's, first off, great advice. Secondly, I think that as a company, if you don't have that expertise in-house and that person has the capacity within their job functions to do this, you should hire an outside expert. And the reason being is because raising capital is a full-time job and it requires a lot of expertise. And most companies do not have that expertise in-house, even if they do, that person is probably consumed by other functions of the company. And you're out there raising capital because you've got a specific need. Hopefully it's an opportunity. And that's when it really makes a lot of sense.
Right. Makes sense. Makes sense. Now, should a business always have a line of credit or business credit cards? Is that something that you would recommend? And how are these used most effectively? Don?
Okay, quick answer, yes and yes. Again, this goes back to a question we answered earlier. Get the credit when you can, not when you need it. And I am a personal proponent of having a line of credit, using it from time to time, even if you don't need it. Just write a check out of it, pay it off the next month, show that you're using it, and so on. Same with credit cards. Now, again, credit cards, we're talking about a very small business, but personal finance 101 is you get a credit card, you buy something on it, you pay it off the next month, you do that for 3, they raise your limit. So, it's just a common sense to get a line of credit as early as possible when you qualify for it. Use it from time to time, even for simple purchases, pay it off. Same with credit cards. Gentlemen, same thing or disagree? I'm okay with.
No, I totally agree. And I'll add one other instance to it, Don. We have a customer who we have an ABL with them. It works like a line of credit. They don't need it, but they keep it open. And the reason they do is because they are constantly looking at buying small distressed companies. And the advantage of having that line of credit is they can go into a deal and say, look, we can complete the diligence in 2 weeks and we don't have to wait for financing. And they just pull down on that line and close the deal. And that's a lot of time is the difference between somebody else getting the deal. Is that they can close so quickly because they have that line of credit in place.
That's good advice. Spencer, anything to add?
Yeah, really good. I'm actually going to speak more towards somebody who might be an entrepreneur, owns their own business context, and is really scrambled as an entrepreneur, which most are. And I'm going to speak to the credit cards, and this may sound like a small thing, but in our world, it's a huge thing, is having unique cards for each business or business unit or business purpose. And it's literally writing on the front of the card what it is. The number of times we have problems with entrepreneurs who have a card that's mixed business and personal, and then we're trying to get from them what's their personal thing, what's their business thing. They don't know. They're waiting 3 months to get us that information. We can't get them information. They can't get a lending package off to Seth. So it seems like a small thing, and it's me because of my business, and we are outsourced accounting. So like but it's one of the more painful things for us when they don't have a distinct credit card. More of a hygiene factor than anything else. But boy, it's so painful when it's not just a separate card, and it's so simple to do.
Okay, great. Well, thank you very much for that. And our next couple of questions have to do more with small SBA 7(a) type loans and related. So Brett is not with us. Seth, how about how can the federal SBA loan program help small businesses?
Well, it just like all loans, well, not all loans, but as the 7(a) loan is really more of kind of a working capital or acquisition type loan. And I will tell you that the companies that I've worked with, where we've done an SBA loan with them, help them with that, it's almost exclusively been because they're doing an acquisition. So it's a very good tool for that. I know there are companies who use it for working capital lines. They are limited to $5 million. I believe that's still the limit, is $5 million. And so, that only works for certain size businesses.
And that kind of has something to do, one of the add-on questions there is under what conditions do small, medium business owners personally guarantee small business loans? Don, you want to take that one on?
Well, I'm not sure I'm the guy, because I'll tell you, I fight with lenders to get the personal guarantee off on every single loan, no matter how big or small. But what I'll say is that if this is your first loan, or the business is still new, or it's struggling, or some other similar type reason, you almost guaranteed to sign a personal guarantee, period. You should go into it thinking about that. Now, an option for that is to say, hey, listen, and a lot of lenders don't get asked this question, but I ask it all the time. I say, well, okay, if we hit our goals in a year, can we take the personal guarantee off? And actually, more often than not, they'll say yes. They'll say, sure, if you hit, you said you're going to be at 10 million in sales next year. If you hit that at the end of the year, we'll wipe out the personal guarantee. So, if you're a small, medium business, you're a solo entrepreneur, you're most guaranteed to sign one, but you should ask if you can take it off if you hit your goals.
Good. Anyone else? Seth?
Yeah. So that's a great point that Don makes, and most people don't realize this, is that it is somewhat negotiable. Now, to that point, every bank for sure is going to ask for a personal guarantee. You may be able to do what Don talked about, where having it taken off. You can also cap it. There are certain instances where you can cap it at a certain amount or under certain circumstances. The other thing, and I find this more with alternative lenders, alternative lenders will be open to the concept of signing what we call a validity guarantee. And that guarantee just basically says you're not, it's not a personal guarantee unless you do something, fraudulent, give fake invoices, give fake financial statements, things along those lines. And as a borrower, you should look to try to, if to get off the personal guarantee, look to offer up a validity guarantee.
Okay.
And just super quick, the one ironic piece of this is typically the smaller your loan, the less likely you're going to be able to get out of your guarantee.
That's
the
true.
Bigger, you do a $200 million loan, what's a personal guarantee? The assets probably aren't going to be there, but you want to borrow 50 grand, it's going to be almost impossible not to guarantee a 50 grand loan. So just be prepared for that.
Yeah. And to that point, for the bigger loans, a lot of times they'll push for it because they want management or the owners to facilitate if there's a problem. They know they're not getting the 200 million back from them, but they want them on the hook, so they're going to stay with the bank to the very end. On the smaller loans, I think the reason that is because at the end of the day, that lender really doesn't want to do a lot of diligence on the company. They want that personal guarantee as a means to get paid back. It just makes it simpler for them.
Mm-hmm. Okay. And you hear this all the time. You hear entrepreneurs coming to you with the greatest and latest idea and business plan, and they want to borrow against that business plan. And is that possible? Can you actually show up with a plan and borrow money? And what does that depend on? Don?
Well, I almost want to say no, but actually it happens more often than you think. There's a couple of things I've put. First of all, you almost have to go through the SBA route. Going back to your question, the SBA will lend on projections. It's not 100% true like that, but what it is that they will take projections. They will look at it and say, yes, you have a solid plan for moving forward. But even in that case, they're going to want an entrepreneur or a CEO that has experience in the industry, that has experience doing what they're doing. If you get somebody that was 20 years as a pharmacist and comes out with a new manufacturing process for steel, it's not going to happen. Well, to be honest with you, you're laughing, Spencer, but it's happened. I mean, people have come and said that. But if you get somebody that's done 3 businesses in manufacturing, and they come up and go, I got a new manufacturing process. I'd like to fund it with a good chunk of debt. I have the track record. Here's my business plan. It's a little bit more capital than I have in the bank, but I want to go forward. You have a much better chance than, like I said, that first opportunity. Now, I'm not saying it's going to be not an uphill battle. Seth will comment on this. You can't get asset-based lending. You don't have any revenue yet, so you can't do factoring. So you really you're really going to have to narrow your focus. Find a local bank, a credit union, somebody else that's got an SBA division, and it could happen because, like I said, SBA typically they will fund on projections.
And Spencer, do you want to answer that? I mean, is there it sounds like you're saying, Don, is that a lot of it has to do with the management, with the credentials and credibility of that management team. Do you agree, Spencer?
Yeah, no, I was going to start there. Don started exactly where I would have. And, kind of the last piece I would tack on is you're probably going to have to come up with some fairly significant amount of your own equity. So the bank's feeling comfortable, for the same reason what Seth answered the last question, and which was a great addition. Thanks to, like I'm committed because I have X dollars in there. I just need a little bit more to get me over the top. That's a much easier sell than, hey, I'm coming in with nothing and can I get something?
Okay, so we're getting closer to our Q&A time, but I just have a couple of quick questions in addition. And you hear a lot about community development financial institutions, local business development institutions. What role can these businesses play with helping a small business owner raise money? Anybody want to take that on? Especially now with some of these specialized broadband initiatives and climate tech initiatives, you see some of these pseudo government organizations. Where do these people fit in? Spencer, you have any thoughts on that?
Yeah, I mean, I can't say I have a ton of expertise in this. I think of it very much, you know, as we were talking about before, we're going to multiple different types of institutions. You may fit into a niche of one of these community development institutions, and it might just be the magic you're looking for. But if you don't fit really closely in alignment with whatever their mandate is, you know, it'll be a nice conversation and you'll probably head on.
And how about insurance products in relation with outstanding loans for a business? What are your thoughts with that, Spencer?
Yeah, I mean, I like Keyman, you know, to cover if anything happens to any of the key senior leaders and then you've got some insurance to cover off the loan amount to take some pressure off. I know in my last business, if I lost my partner, I don't know that like the business was reliant on him and me based on our size and where we were at. So we did have Keyman in place just to cover if there was a catastrophe. I mean, technically it's actually not Keyman insurance, but I really mean just having debt, like a life insurance to cover the amount of debt so that the business doesn't have to maintain the debt in the absence of a key person, but it's just truly a life insurance plan.
I know that we look a lot of times for business interruption insurance, particularly being down here on the Gulf Coast.
Okay. Anybody else on that one?
I'll just add also that sometimes life insurance can be used as collateral for a loan. You can, if you really don't want a personal guarantee, or let's say, I don't know, there's issues with the relationships, family relationships and stuff that make it difficult. Sometimes I've had entrepreneurs put up life insurance policies and other insurance policies like that as collateral. So something you can use.
Okay. Okay. Another question is, what are the lending risk categories for small businesses? If we can identify them, I guess a banker would say the 4 C's, right? Are the risk categories, right? Anybody else want to add or want to opine on what these lending risk categories are? Did I stump you guys?
I'd like to know what the 4 C's are, please.
Yeah.
But from what I understand, it's character, capacity, collateral, and what's the last one?
Charm, if it's Spencer.
Right.
We're talking about now, it's not the categories, but it's the 4 primary determinants of giving a loan or giving lending to an institution. But we've already talked about most of them, right? Character, does the entrepreneur have experience in that industry? Collateral, do they have anything to put up for asset-based lending or factoring? So I think we've already discussed the 4 C's in general. Again, if you come with 3 of them, there's still a chance you can get some lending. 2, you're not going to go anywhere. 1, you're probably not going to get some type of lending facility at all.
I think, credit was a lot. Yeah. So what about, how can a small business increase its business credit score? Seth?
Probably the best advice I could give is work with vendors who report. Pay your vendors on time, but make sure they're reporting vendors. Most people don't take that into consideration, and you can have great credit with a company, and no one will know it unless they sign up on an application. So my best advice would be ask that question to the vendor: do they report?
And I'm gonna go a little bit further than I'm gonna be more pragmatic to that answer. Unfortunately, pay pay the service to monitor your credit if you get to that point. Let's be clear. Bad credit basically means that in a business that your Dun & Bradstreet report shows bad credit. And unfortunately, that's a pay for play where you pay them $1,000 a year and they will monitor your credit. They will clean up bad AP. They'll contact your vendors and everything for you. I'm telling you right now, the best way to do it is just pay them because they'll fix any problems that you have. Paul, if I can interrupt, we do have a question on the chat board we can answer. And we're here at 2:56. We might want to move to Q&A after that. I have a question from David Unger. Is it okay if I read it, Paul? Do you mind? How would you suggest that personal guarantees would work if there are 3 equal partners? So that was something I was going to answer earlier. I'll say real quick, it's anybody over 20% is going to be asked to sign a personal guarantee, period. So if you have 3 equal ones, I would say that if I was one of the 3, I would ask all 3 to sign. And if I was a banker, I would want all 3 to sign as well. They may have different asset levels, they may have different wealth levels, but I would still ask all 3, if they're going to be helping the business out and they're equal partners to answer, to sign off on that. Seth, Spencer?
Again, we don't take personal guarantees, but on what I've seen with other bankers is any principal that has more than 20% ownership in the company is going to be asked to sign that personal guarantee.
Yeah, I think Seth said they don't take personal guarantees and is about to get a flood of emails. But if there are partners, there's also a couple ways it can be structured. And I'm having a mental block with the particular name, but there's joint and several, and then there's the opposite of joint and several, forgive me. But one of which is everybody's on the hook for the whole amount. And then the other version is you're on the hook essentially for, say, your 1/3 if you're a 1/3 partner. If I'm going to be signing a guarantee with partners, which I've done in the past, we absolutely want to have it where we're each responsible for whatever our relative percent is, rather than everybody owing everything.
Yeah, and to your point, that's a great point, Spencer. It's joint and severable, and most of the banks are going to come out of the chute with that.
And that's where everybody owes. Everybody's responsible for all the debt is joint and several. And for some reason, I'm just stuck on the opposite term. I'm blanking on it right now, but avoid joint and several if you can.
Okay, last question is so for in a business with a low credit score, what type of loan types are available? Are any available or?
Yeah, I would say that, and I'm probably not. There's probably more than that I'm aware, but the 2 most common ones I will see are merchant cash advance loans and factoring. Both of those can be done with a very low credit score. And factoring technically isn't a loan, but it kind of is. That would be, I find I work with a lot of startups, and factoring is the method that works the best when they have no credit to get going.
And it's more expensive, obviously, but.
Okay. Well, we're just about out of time. And
can I just throw in a very, very quick
Spencer,
comment as well? Is really be thinking about other creative options. So, if you have a longstanding relationship with a landlord and you need to do some tenant improvements, that can often be worked into the lease with a loan directly from them if they're well funded. Individuals is another way where private individuals, it will again cost more, but there might be more flexibility if you have a story, if you have a connection, if you have a particular compelling reason for them to invest in the business in a way that maybe conventional or even secondary lenders won't do.
Okay. And now we do have another question from our audience. If you have 2 different businesses under one LLC, does the lender focus only on the business unity that you're attempting to secure the loan for specifically? So an example of that would be a construction build loan for a property. Financials are only involved in the property versus the other side of the business. So if you have 2 different businesses under one company, 2 different operations, does the lender focus only on the business unity that you're attempting to secure the loan for?
Yeah, the short answer is going to be Yeah, now, the short answer is going to be the lender is going to look at the LLC, not the two divisions below it. If it's all rolling through an LLC, they're going to look at the LLC in its entirety because there's really no way to break that out from a financial standpoint or from a security standpoint. I'm sorry.
Anybody else?
Seth, I'm going to counter that. The example was a construction build loan for a property, and let's say they have a construction business on the side, on one side of the LLC, and the other side is let's call it rental management business for lack of anything else. There's also an option, right, where they could get a loan just on the building, not necessarily the LLC, right?
Yeah, that's a little. You're right. You're right, Don. That's a little different. It's going to be specific to that asset.
Right.
And they may just take the collateral, but at the end of the day, they're going to want the LLC to sign the paperwork.
Yeah, that's what I was going to follow up with. And you're still looking at the LLC, but the ABL could be on the building or on the piece of equipment or something.
Yep, absolutely.
Okay. Any other messages from our audience? I don't see any other messages. And I guess for anyone out there that's watching and could not attend, or someone that's watching or knows someone that could not attend, there will be a recording of this webinar on the sponsors' website. And those sponsors, again, are Funding Strategies, the Funding University, and ThermoCredit. And in conclusion, I want to thank everyone who attended today and our panelists, Seth Block, Brett Atkins, Spencer Sheinin, and Don Noble, and our guests, of course. We hope you found our discussion about smart loan options for small businesses useful and informative, and we'd love to hear your thoughts. So please fill out a post-event survey, which will be emailed to you if you signed up for this. I'm Paul Stamoulis, and again, thank you to our sponsors, Channel Vision Magazine, Remote Work Solutions, or RWS, the Funding University, and ThermoCredit. We will have another event titled The Real Cost of Doing Business. And that info on that event will be available after the webinar. So please come back and visit the site for our next event. And once again, if you'd like to listen to the recording of today's event, it will be posted on the ThermoCredit Funding University Funding Strategies. This webinar is part of a free series of talks hosted by the Funding Strategies Conference. Thank you to them. And thank you for joining the conversation and wishing everyone a great holiday season. And goodbye, everyone.
Thanks, everyone.
Thanks, everyone.
Take care.
Bye-bye.